as a retiree, should you be a growth investor or a value investor? In today's video, we're going to talk about the difference between being a growth investor and a value investor. We're going to go through some history that talks about returns, and then we're going to talk about specifically for retirees, what is an important consideration in your portfolio when you're thinking about investing in value or investing in growth. Okay, let's get started. When we talk about what does it mean to be a growth investor or a value investor? Well, let's change the words growth and value, and let's change growth to expensive and value to cheap. Now, why would anyone buy something that's expensive versus something that's cheap? Well, because future expectations are very high, therefore people are willing to pay more for a growth or an expensive investment because they think earnings are going to go up, or it's going to make a lot more money and it's going to be really successful. So people are willing to pay more, and have historically paid more for growth investments over value. Versus value, we say, well, maybe the future's unknown and I would rather buy it at a low price today than count for things happening in the future. And so philosophically, if you're a growth investor, you are betting on a bright future for companies and you're willing to pay a premium for it. If you're a value investor, you don't really want to account for the future and you want to get a good price today. Now, we're not talking about necessarily value or growth being good or bad. We are going to talk about some history, and then we're going to talk about how to think about it as retirees and the unique considerations that they should have when it comes to selecting a style of investing. Okay. So value is buying cheap companies, growth is buying expensive companies because we think they're going to get more valuable over time. What does history tell us? Well, if you go back all the way to 60 years or so, or even longer, over time, value has done slightly better than growth. Now, there have been times when growth has done better than value. There's been times when value does better than growth, but on the whole, value has outperformed growth by a small margin. Now, you wouldn't know that based on the last 10 to 15 years because growth has done so well relative to value. It's done fantastic. And it's got many people questioning, well, why should I be a value investor at all? That's what we're going to talk about. But overall, if you go back several decades, value or buying less expensive stocks at a low price has done better than buying expensive stocks hoping they will grow into that larger price. Okay, why are we talking about this? Let's give some specific numbers in terms of why is this important when we're understanding value investing versus growth investing relative to retirees. And the reason that it's important and what's unique about retirees, when you're retired, you're pulling money out of the portfolio. And when you are pulling money out of the portfolio, when you talk to a whole lot of advisors, the one big risk that retirees face, or one of the many risks, but one of the biggest that retirees face in retirement is what's called sequence of returns risk, which means, in particular in the early years of retirement, you don't want to be pulling out of a portfolio as it is dropping. It becomes much more difficult to recover. And so it's really important as a retiree that we have a portfolio that's relatively stable. Now, keeping in mind, we're talking about the stock portion of the portfolio, so it is naturally unstable. It goes up and down. It is volatile. But we're going to compare specifically growth and value in its worst time periods if you were a retiree, and then you can make whatever conclusion that you'd like. Okay, so let's go back, and again, this is the last 60 years. Let's start with the worst performance that we've seen from value investing. Now, this is coincidentally a recent 10 years. So this chart here looks and gives us the worst performance over a 10-year time period over the last 60 years. And it was from 2010 to 2020. Okay, if we would have started with $1 million, we would have ended up with a little under $1.5 million. So we made about 50% over that 10 years. That is the worst performance small cap value has done over that time period. And so, okay, that's not terrible. It's not great. It's not doubling your money, but you have made a little bit of money. It's done fine. And so when you're talking about value, in particular, smaller, cheap companies, the worst that it's done over the last 10 years is up about 50% over that 10 years. So let's call it around a 4% compounded rate of return. Well, how about growth? Well, this chart here looks at growth. And that is giving us a different story. So if we started with $1 million, coincidentally, it's the 10 years before value underperformed. That's usually how it works. One does well, then the other does well, and they flip-flop. But we're going to look specifically at what does underperforming look like. We're not so worried about what outperformance looks like because everything will be fine. But we don't want to not be on track for our goals if the portfolio underperforms. And so With value, we know what that did. How did growth do when it underperformed? Well, if we would have started with $1 million, we would have ended up 10 years later with around $700,000. So your million would have dropped to 700,000 over that 10 years versus in small cap value, looking at this other line, would have grown. So that is a dramatic difference when it talks about underperformance. Because again, it doesn't really matter what happens if everything goes great. When you're retired and you're pulling money out of the portfolio, what we're most worried about is things going poorly and that derailing your plan. Now, I want to show you one more piece here. So we've seen what small cap value and what growth does in its worst time periods, but what's the reality as retirees? We are taking money out of the portfolio. So let's look at the same chart with, and I'm assuming $1 million at a 4% withdrawal rate, so that's $40,000 a year coming out of the portfolio. What happens in both of those scenarios? So let's start with value and small cap value. Well, in that situation, you started with $1 million, you were pulling out $40,000 a year, and you ended up after 10 years and pulling out $40,000 a year with a little over 1.1 million. So you've pretty much lived off the money that the investments have earned. Okay, it's not amazing. You ended with what you started with and you've been taking out some money. That's not terrible, but keep in mind, this is its worst performance in 60 years. Okay, well, what about growth? As you can imagine, it's not going to be pretty. So if we would have started with that $1 million, and we would have taken out our 4% or $40,000 a year, we would end up with around $450,000. Now, in one scenario, we started with $1 million, we took out money, we ended up with more than $1 million. The other scenario, we started with $1 million, we took out 4% and ended up with our money cut in half. Those are very different outcomes, but it is important that when we're looking at investments to understand what's the worst that could happen. Now keep in mind, this is not the worst that could happen. Anything could happen. This is just the worst that has happened over the last several decades. Why is that? Well, it's because with value investing, by definition, it's cheap, so it doesn't really get overheated. It doesn't get that expensive relative to itself. Versus growth, right? We're seeing that today. We're seeing that right now. You're hearing about all these great companies with sky-high valuations and sky-high future expectations, and that usually doesn't work out. When people start overpaying for great companies, it's still a great company. It's just not a great price. And that gets reflected in long-term returns when people start to overpay. That doesn't happen as much as value investing as it does in growth investing. And so as a retiree, kind of summing all this up, should you be a value investor or a growth investor? Now keep in mind, this is not financial advice. You should talk to your financial advisor about what is the strategy that we're employing, but keep this in mind. As value, right, it doesn't get really expensive or really cheap. So the returns, even the worst case scenario, has been just fine. Versus growth, that's a different story. So if you're on the right side of performance, it's fine. But if you end up in one of those down years or down decades, which right now, growth is pretty expensive. So I don't think many professionals would be that surprised if we had some underperformance and you're taking money out, it could spell trouble for your portfolio. So get with your advisor, determine what does my portfolio look like in the context of value or growth? Do I understand it? And as I always say, know what you own and know why you own it. Hope you found this helpful. And as always, thanks for investing your time with the Personal CFO.